You see the ad everywhere. Buy a home with as little as 3% down, 0 down via loan. FHA, only 3.5% down. Your dream home is waiting. You do the quick math, a $500,000 house with 3% down equals just $15,000 out of pocket. That feels achievable. You've been saving, you have decent credit, and your household makes $130,000 to $160,000. You think finally we can stop renting and actually own something. This is the smart move in 2026. That exact thought, low down payment is the way to go, is one of the most expensive financial traps you can fall into right now. Because in 2026, low down payments are quietly killing middle-class wealth, and most people don't even realize it until years later. Here's the reality check: 60 to 70% of first-time buyers in 2026 are putting down less than 20% NAR and Freddie Mac data. That forces them to pay private mortgage insurance PMI an extra $100 to $300 per month, $1,200 to $3,600 per year. That does nothing for you. PMI plus larger loan equals higher monthly payments, slower equity buildup, and a much higher chance of becoming house poor. Over 7 to 10 years, the average buyer with low down payment loses $25,000 to $60,000 plus in extra PMI and interest. Money that could have gone into investments or retirement. This isn't a small fee. It's a hidden tax that lenders love and borrowers hate. And it's one of the biggest reasons so many responsible buyers end up financially squeezed in 2026. Today I'm going to break down the PMI trap in full detail, why low down payments are destroying your wealth, the real math over 5 to 10 years, the hidden costs most people miss, and exactly how much you should really put down to avoid regret forever.
Let's build our down payment.
If you're currently saving for a down payment, shopping for a $450,000 to $600,000 home, or already have a low-down mortgage, this video is for you.
It's a common pitfall many fall into,
because
but don't
understanding
worry,
this one
we can
trap
avoid
could
it.
save you tens of thousands of dollars and years of financial stress. Let's start with what PMI actually is, and why it's called a trap. The U.S. housing market in 2026 is a perfect storm for low-down payment buyers, and it makes the PMI trap more dangerous than ever. Median home price is $430,000 to $450,000, growing slowly at just 2 to 4% from 2025 Redfin/Zillow/NAR forecasts. That sounds stable, but 30-year fixed rates are still 6.2 to 6.9%, double the pandemic lows. So monthly P&I payments are 50 to 100% higher than 2020 to 2022 buyers enjoyed. Middle-class incomes $80,000 to $200,000, gross $60,000 to $140,000 take-home can barely keep up. 60 to 70% of first-time buyers put down less than 10%. FHA, VA conventional low-down programs are popular. That means larger loans and mandatory PMI, typically 0.5 to 1.5% of the loan amount per year. $100 to $300 per month on a $500,000 home. Why is this so risky now? Housing cost inflation, property taxes, insurance, utilities is rising 5 to 15% per year in many markets, faster than wage growth 2 to 4% after inflation. Larger loans from low down payments amplify P&I payments by 20 to 30%. PMI adds $1,200 to $3,600 per year with no equity benefit. Combined low down plus high rates plus rising costs equals house poor hits. Fast. Example: a $150,000 household buys a $500,000 home with 5% down $25,000. Loan $475,000 to P and I $3,050 per month plus PM I $200 per month to total housing. $4,000 to $4,500 per month, 45% plus of take home, One tax reassessment or insurance spike later, and they're underwater. This market isn't forgiving to low-down buyers. That's why we need to understand exactly what PMI is and why it's a wealth-killing hidden tax. Let's break it down. Private mortgage insurance PMI is not insurance for you. It's insurance for the lender. If your down payment is less than 20%, most lenders require PMI to protect themselves in case you default. You pay the premium, but if you stop paying your mortgage, the insurance covers the lender's loss, not yours. You get zero benefit. It's a pure cost. How is PMI calculated? It's typically 0.5% to 1.5% of the original loan amount per year, depending on your credit score, down payment percentage, and loan type. The lower your down payment and credit score, the higher the rate. Real example for a $500,000 home in 2026, 10% down $50,000 to loan $450,000. PMI rate 0.8 to 1.0% good credit to $300 to $375 per month, $3,600 to $4,500 per year. You pay this every month until you reach 20 to 22% equity, either through paydown or appreciation, or until you refinance to drop PMI. Average duration 5 to 10 years in today's market. Slower appreciation plus high rates means slower equity buildup. The trap deepens because PMI does not decrease over time. It stays fixed until you hit the equity threshold. If home prices stay flat or grow slowly, common in 2026 forecasts, you stay stuck paying PMI longer. No PMI with 20% down saves $20,000 to $40,000 plus over 5 to 10 years. Money that could go to investments, retirement, or emergency funds. This connects straight to our hidden costs series. PM1 is one of the largest hidden taxes for low-down buyers. Money lost forever with zero upside for you. Next, the first big reason low down payments kill wealth. Larger loans mean higher monthly payments and more interest paid overall. Rule number 1 in understanding the PMI trap. Low down payments force you to borrow more, and borrowing more means permanently higher principal and interest P&I payments, plus tens of thousands extra in interest over the life of the loan. Let's run the numbers for a realistic $500,000 home in 2026 at a 6.7% fixed 30-year rate, current average range. 5% down, $25,000 loan amount, $475,000 arrow. P&I approximately $3,050 per month. 10% down, $50,000 loan, $450,000 to P&I approximately $2,900 per month. 20% down, $100,000 loan, $400,000 to P&I approximately $2,560 per month. Difference between 5% and 20% down, $490 per month just in P&I, or $5,880 per year. Over 30 years, that extra borrowing costs you $176,000 more in payments, plus tens of thousands more in interest, since interest is front-loaded. The risk is even higher if you choose an ARM adjustable rate mortgage to get a lower initial rate. If rates rise 1 to 2% after 5 years, your payment jumps $500 to $800 per month overnight. Your income dips, layoff, bonus cut. Larger loan means less cushion. You end up house poor faster because the monthly nut is bigger from day one. Advice: if you can't hit 20% down comfortably, wait and save more, even if it takes 2 to 3 years. The savings in P&I and interest far outweigh the delay. Low down payment feels like getting in now, but it's actually paying a premium for decades. This leads to reason number 2, PMI itself. The extra monthly fee that adds insult to injury and slows your equity buildup. Reason number 2, PMI is pure lost money. It's an extra monthly fee that does nothing to build your equity, reduce your loan, or protect you in any way. PMI typically runs $100 to $300 per month for a $500,000 home with low down 0.5 to 1.5% of loan amount per year. Depending on credit and down percent, that's $1,200 to $3,600 per year, $12,000 to $36,000 over 10 years. Gone forever. Real example, $500,000 home, 10% down arrow loan, $450,000. PMI rate 0.9% good credit, $338 per month, $4,056 per year. You pay this until equity reaches 20 to 22% through pay down or appreciation. In 2026's slow growth market, 2 to 4% appreciation forecast, it often takes 7 to 10 years to drop PMI. Total PMI paid $28,000 to $40,000, money that could have gone to investments. The slowdown in equity, that $338 per month, is not paying down principal, it's just a fee. You build equity slower than someone with 20% down, no PMI smaller loan. If you invest the no PMI savings at 7 to 9%, S&P 500 average $338 per month compounds to $30,000 to $45,000 in 7 to 10 years. Real wealth you lose by paying PMI. Risk slow appreciation in 2026 means PMI lasts longer. If you refinance later to drop PMI closing costs, eat another $5,000 to $10,000. Combined with larger loan from low down, your double hit. Higher P&I plus extra PMI fee. No PMI 20% down means $20,000 to $40,000 saved over 10 years, plus faster equity and lower overall stress. This is why low down payments are a trap. They don't just add PMI. They slow your path to real ownership and wealth. Next, how low down plus PMI creates a debt snowball and makes house poor almost inevitable. Reason number 3, low down payments plus PM. I push you straight into house poor territory, and once you're there, one unexpected hit can start a debt snowball that's extremely hard to escape. When you put down less than 20%, your loan is larger, P&I is higher. Add PMI $100 to $300 per month. Your all-in housing cost jumps 10 to 20% higher than someone with 20% down. For a $150,000 household, buying a $500,000 home, 5 to 10% down plus PMI. Arrow total, monthly PITI plus maintenance plus utilities, often hits $4,000 to $4,800, minus 45 to 55% of take-home pay. That's textbook house poor. 40 to 55% of income locked into housing, leaving almost no margin for life. The real danger: unexpected repairs or income dips trigger a debt spiral. A $20,000 roof or $15,000 VAC failure hits to no cash buffer because down payment drains savings. You charge it to credit cards, 18 to 25% interest, or take a HELOC more debt. Higher monthly payments from debt to even less cash flow to harder to pay off to snowball effect. One crisis turns into chronic stress. Late payments, credit score drop, more expensive borrowing next time. This connects directly to our House Poor series. Low down payment doesn't just add PMI, it amplifies the entire trap. You're not just paying extra, you're making yourself vulnerable to every hidden cost we talked about: repairs, insurance spikes, tax increases. No margin means no resilience, and middle-class families in this spot often stay stuck for years. Low down feels like getting in the game, but it's actually stacking the deck against you. Next, the longest-lasting part of the trap: how hard it is to escape PMI once you're in it. Reason number 4. PMI is extremely difficult to escape quickly, and in 2026's slow growth market, you can be stuck paying it for 7 to 12 years or longer. PMI automatically drops when your loan-to-value LTV reaches 78%, equity hits 22%, Or you can request cancellation at 80% equity, 20% down equivalent. But here's the trap: equity builds slowly through principal paydown and appreciation. In 2026, national home price growth is forecasted at 2 to 4% per year. Redfin/Zillow/NAR, slower than historical averages. That means it takes much longer to reach 20% equity. Real example for a $500,000 home with 10% down, $50,000 loan, $450,000. Appreciation 3% per year, home value reaches $670,000 after 10 years. Principal paydown $100,000 to $120,000 over 10 years, early payments, mostly interest. Equity $220,000 to $240,000. After 10 years, you finally hit 20% equity around year 8 to 10. Total PMI paid $19,000 to $36,000 at $200 to $300 per month. Money lost forever. Risks that make it worse: if appreciation slows to 1 to 2% possible in flat markets. PMI lasts 10 to 15 years. Refinancing to drop PMI. Closing costs $5,000 to $10,000, plus current rates 6.2 to 6.9% may not save enough to justify. Your maquette, paying extra $200 to $300 per month with no equity benefit, delaying wealth building. Compared to 20% down, no PMI at all, that $200 to $300 per month invested at 7 to 9% grows to $20,000 to $40,000 in 10 years. Real money in your pocket. This is the long tail of the trap. Low down payment doesn't just cost you up front. It keeps costing you month after month, year after year. Next, how this entire chain, low down plus PMI plus larger loan, creates a perfect storm for debt and regret. The good news is the PMI trap is completely avoidable, and even if you're already paying it, there are clear ways out. Here are the most effective, realistic steps to protect your wealth in 2026. Advice number 1. Save aggressively for at least 20% down, even if it takes 2 to 3 years. Don't rush in with 5 to 10% just because lenders say you qualify. Waiting to hit 20% eliminates PMI entirely, reduces your loan size, lowers PMI, and gives you instant equity cushion. For a $500,000 home, 20% down, $100,000 saves $20,000 to $40,000 plus in PMI over 7 to 10 years compared to 10% down, plus lower monthly payments, $340 to $500 per month savings on PMI. Total long-term savings $100,000 plus when you factor in less interest and faster equity. If you're short on cash now, live lean side hustle, cut non-essentials. Treat the extra down payment as the highest ROI investment you can make. Advice number 2. Explore lender options that avoid or minimize PMI, but be cautious. Some lenders offer piggyback loans 80-10-10 or 80-15-5, first mortgage at 80%, LTV no PMI, second loan for 10 to 15% down. But beware, second loans usually have higher rates, 7 to 9% plus, and you're still carrying more total debt. Only use if you're confident in fast equity buildup or plan to refi soon. Better alternative: conventional loans with lender-paid PMI. They raise your rate slightly instead. Run the numbers to see which saves more. Advice number 3. House hack to accelerate equity and offset costs. Buy a duplex/triplex or single family with ADU/basement rental. Rental income covers 50 to 100% of your mortgage. Example: duplex, $550,000 rent, 1 unit, $2,000 per month. Arrow, your net housing cost drops to $2,500 per month instead of $4,500. Faster principal paydown plus rental help equals quicker path to 20% equity. Arrow, drop PMI sooner. Common mistake to avoid: I want to buy now, so I'll go low down and deal with PMI later. That mindset leads to regret, years of extra payments, slower wealth, and potential house poor. Delaying to save more almost always wins long term. If you're already in a low down loan paying PMI, don't panic. We'll cover escape options in the conclusion. The PMI trap isn't a small annoyance, it's a wealth killer. Low down payments don't just add extra monthly fees. They force larger loans, higher interest, slower equity buildup, and a much higher risk of becoming house poor. In 2026's high-rate, slow-growth market, skipping 20% down can easily cost you $25,000 to $100,000 plus over 7 to 15 years in PMI, plus extra interest, money that could compound into real wealth if invested instead. Final advice to avoid or escape the trap: always calculate full cost with PMI included. Never decide based on P&I alone. Add $100 to $300 per month PMI if down less than 20% project. How long it lasts: 7 to 12 years in slow markets, and compare to 20% down scenario. Prioritize 20% down, save aggressively 2 to 3 years if needed. The savings in PMI, lower P&I, and faster equity far outweigh buying now. If already paying PMI, escape as soon as possible. Make extra principal payments to reach 20% equity faster. Monitor appreciation. Request PMI cancellation once you hit 20%. LTV appraisal may be needed. Refinance when rates drop. Aim for 5.5 to 6%, or when equity reaches 20%, but only if closing costs make sense. House hack if possible. Rental income accelerates equity and offsets costs, shortening PMI duration. Bottom line: low down payment in 2026 is not an opportunity. It's a trap that leads to regret. Wealth comes from smart decisions, not rushing in with minimal cash. Protect your future by following the math, not the lender's easy entry pitch. So where are you right now? Planning a low down purchase, already paying PMI and feeling the squeeze, or saving for 20% down? Drop a comment with your rough numbers: household income target, home price, down payment, saved/planned city/metro area, current rent if renting. I'll run a quick PMI trap analysis for your situation, how much it could cost you, and whether 20% down or other moves make sense. Thanks for sticking through this full breakdown. This isn't the feel-good just buy now message, but it's the truth that can save you tens of thousands and years of stress. See you in the next one. Make choices that build wealth, not traps.